All right, everybody, welcome to the show. As always, this is Capital Interactive with Basim and Adam, and we have a really good topic today, and I think it's one that affects most every business because it's where you do business. And what we're talking about specifically is what is owner-occupied real estate, and there's a lot of terminology and factors that go into it, but it's something that's it's very exciting, and not a lot of people know the ins and outs. So I think it's a great topic today, and we got a lot of juicy information here. In this podcast.
I mean, this is going to be really good because every business needs a place to operate, and not only that, but this is actually probably where most commercial banks love to lend.
Correct.
They love it if they can lend to you to your primary place of business. And so there's a few things that actually identify something as owner-occupied real estate. And what are those things?
Yeah, no, absolutely. I'll start just kind of very generally. Obviously, your main place of operations occurs in owner-occupied real estate, but also how much of that real estate you occupy really is something that, in the view of the bank, is important because it is going to be the primary repayment source. So as a general rule of thumb, 51% or more of the raw square footage of the real estate in question is occupied by your main operating business.
And that can include common area.
Correct.
So if you have like a common cafeteria that the whole building uses, or you have hallways that people use, all that gets to go towards your percentage of occupancy in your owner-occupied real estate. And that's actually one of the biggest places. So occupancy square foot percentage needs to be above 51%. Another thing that I've seen some banks do as well is they'll say, okay, you have to have your primary source of business in there, but if you want us to consider this as owner-occupied real estate and you're not 51% of the
we won't rely on the other income, right?
We cannot rely on any of the rents that you get from the other tenants as income. Right. If you can service the debt with your own funds, with your own earnings, we'll consider it.
Right. That's a good point. So let's assume you occupy 60%. We're lending to you.
Yeah.
I'm in the other 40%. The bank wants to know that if the other 40%, my business, I go away tomorrow, you didn't need me. You didn't rely on me to make the note because there's no guarantee. I'm not part of the deal. I'm not guaranteeing it. Even if I have a lease, something could happen. The bank wants to know that should you have a tenant, that's icing on the cake. That's great.
Yeah.
We won't look at that.
And one other thing I hear a lot is say, hey, Basim, well, I don't feel comfortable having the real estate in my company's name. Like I want to create a separate single purpose LLC, and all it's going to do is hold the real estate for me. Yeah. Well, I mean, then I'm not operating my company out of there anymore. Is that still going to be considered?
It's not an issue, and actually, I'd say that's more common than not. Is to what we call REHC, Real Estate Holding Company. Absolutely, and I'd say most businesses operate in that fashion, where they create a separate entity to hold the real estate. Now, with that, yes, the main operating business is going to be on the note. We will lend directly to our real estate note will be to the real estate holding company, with the operating company providing a guarantee. But that's not a deterrent, as we mentioned earlier. So long as you can service the debt from the operations alone by yourself, I think it's a smart thing to do.
Yep, that's something that we see, like we said, a lot. Single entity, single purpose LLCs for holding companies of the company. That's great. Okay, so that kind of talks about what the real estate is.
Yeah.
Okay, what owner-occupied real estate is. So you're operating your business there, even if it's in a holding company. You're occupying at least 51%, or depending on the bank, you can service the debt without the rents. Okay. Now, most of the business owners, the business owners that I've met, the ones that are the first time buying real estate, their only experience buying real estate has been with their home.
Correct.
Okay. So when we start talking to them about terms on their loan, there seems to be a little bit of confusion. Let's talk a little bit about how the amortization works. Well, let's start with amortization and tenor.
Yeah. Tenor being the term, tenor being time until maturity, and amortization being the life that the note will be divided upon. So that's a good starting point. When we talk about personal real estate, your home, you typically get fully tenored, fully amortized loans, i.e. if I apply for a 30-year mortgage, Adam gets a mortgage, I get a 30-year term, a 30-year amortization, and that's how it works. With commercial properties, it's different. you'll typically have a term that's significantly shorter, and even an amortization. You don't see 30-year amortizations on commercial real estate, with a few rare exceptions. I know the SBA can dabble in that from time to time, but on average, you'll get about a 20 to 25-year amortization. That's the life of the loan, but you'll have a maturity date that comes up much faster than that, typically between the 5, 7, and maybe 10-year terms. Now, the bank does that in a very purposeful way. So when this all boils down and comes back to risk, and that's the risk of the deal. We don't want to set a commercial property out 15, 20, 30 years, because things can happen and things change in that time. So what we'll do is we'll set up a 5-year term on the deal, with the expectation being in 5 years, it will have collected updated financials and kind of rerun the numbers. Just look at how the business is doing to re-up them for another 5, 7 years with the remaining amortization.
Exactly. And so even 20 years, a lot of banks don't necessarily like going 20 years. They'll kind of do that. The SBA pretty much allows for 25 years. But so the way it's working is, when you're calculating your payment, you're going to calculate your payment based on the amortization, but realize you're only going to have that payment for the length of the term.
Right.
At the length of that term, when the term is over, you're going to have a balloon payment due.
Correct.
That balloon payment, then it's the expectation of the bank that we're going to refinance it typically. So let's say you have a 5-year term with a 15-year amortization. That means that the payments are going to be spread out evenly among 15 years, but your term is going to be over at 5 years. So after 5 years, you've got 10 years left at those payments to actually pay off the note, but they're all due at once right now. So that you've paid 5 years basically, and now you have this balloon payment. And most banks, they're gonna want to refinance that. I mean, it's not like but they want to relook at the deal. And so that's why they're putting that shorter term in there, because the risk environment could have changed, rate environment could have changed. They want to be able to come back to the table and say, let's see how you're performing, and let's revisit this after 5 years or 7 years or 10 years, But really, I think most banks would like 5 to 10 years on the term, and then really 15 years to 20 years on amortization.
Right. And one other point that factors into that is, so when we're talking about commercial property, which different from residential property, is there's a lot of different properties that vary in terms of useful life. And useful life really is an important factor, because there's different spaces that over time, if it's very industrial, there's a lot of breakdown in the type of structure that it is. It might need certain capital injection to keep with times, be it environmental or otherwise. So that's also why the term can be kept on the shorter end.
And actually, I think that's actually a good segue into one of the next things I want to talk about, and that is the down payment, because most people are familiar with, like I said, residential real estate, and they know that a conventional deal is 20% down. When it comes to commercial real estate, that specialty use or the type of use has a big part, or plays a lot into the amount that you actually have to put down into a deal.
Right.
Can we talk just a little bit about specialty use buildings and kind of what you see from an LTV standpoint or loan to value standpoint on these particular types?
Absolutely. The standard, now we're talking about standard commercial properties, be it office and so on and so forth. Yeah, you'll be at that 80% loan to value, i.e. the loan can't be more than 80% of what the true equity of the property is. But when you start to delve into more specialty use property, kind of one-offs and types of buildings that are different in very specific ways. Let's take dental offices is always a good example, because there's a couple things that go into it. One, there's a very certain client base that would be interested in that property on resale. You're not going to turn around and sell a dental office to then become a full-fledged gym. There's only a small group of buyers for that type of property, number one. Number two, should you want to change it somewhere along the line, you find a buyer that likes it but wants to do it, there's a lot of leasehold improvements and capital that needs to be injected to get it from point A to point B. As a result of that affects your loan to value at certain times. I mean, specialty use could be in the 60 to 65% loan to value due to those aforementioned
let me give you
criteria.
two examples that I think kind of illustrate the point. And I think I talked about one of these deals in the past, and that is we worked when I was at a bank a few years back. We worked with a water therapy center.
Yeah.
And so basically
They
what
have a
happened,
pool in the middle,
yeah,
right?
there was an office space. There are all these offices surrounding this pool in the middle of their building, and they were treating patients in the pool, helping them do physical therapy. Okay. We only advanced like 60 or 65% of the value on
Yeah,
that.
who you going to sell that building to?
Yeah.
As is, assuming you
Yeah.
don't make any adjustments, you keep the pool in it or
Yeah,
whatever. You want a common area for employees to swim. Who other than a water treatment or water physical therapy type business, how many of those are there?
I know.
Like, who are you going to sell this to?
So another example, I worked on a deal for this big ice manufacturer. So like basically the
Yeah,
company,
big fridges in there and stuff.
they converted a huge portion of their warehouse space into a walk-in freezer.
Right.
And so they had a slanted floor. They had these cooling panels and insulation along the sides. It was all connected into the building, and so we were only able to offer a certain amount of loan to value on that. So it was like probably, I think it was like 65% again on that one. But those are like examples when there's something specific about your needs in that building, then that's going to reduce the amount that the bank is willing to be willing.
That
to
will require you to bring more capital to the table.
Yeah.
So again, something to be prepared for, knowing what you're getting into and why the landscape might be a little bit different.
Yeah. Okay. So now that talks a little bit about term and amortization. Let's talk about the payments. Okay. So payments could be different than what you're used to. So when you're doing a regular mortgage on your house, you might be used to having principal and interest in one payment, the payment being the same.
Payment is always the same month to month over the course of 30 years, assuming you don't refinance.
Yeah.
Right?
And so that's something that banks can do.
Yeah, we can do that.
Like they can do that for you if you want, but actually, depending on how your rate is done, like if you have a floating rate, a lot of times deals will be done on a floating rate.
Right.
Well, you're going to have principal plus interest. And so what does that mean? That means over the course of your loan, the payments are going to be different.
Right.
Because in
The floating rate will impact the interest you're paying in any given period.
Yeah, but not only that, but you're going to be paying down principal. And because you're paying down principal, the proportion in interest is actually going down as well.
Right.
And so, a lot of times people aren't aware that they're doing that. And in the beginning of your loan, it could look way more expensive. Like I had a client of mine that had that did an SBA deal, and I inherited the deal. And he had a floating rate on his deal. And when he got to sign the documents, he didn't realize how much of a difference that was going to be for him on a monthly basis. And it was almost $4,000 in the beginning. Like at the end of the loan, it's probably less. But we actually, after a few years into it, he's like, would you mind if we kind of convert this? And then we had to go through like a credit restructuring and convert the rate into a fixed rate and have the same monthly payments.
Right. I think it's a good question to have with your bankers is how it's going to be structured.
Yeah.
And I think a lot of that is also you have to be very mindful and you should be, having this conversation with your banker in terms of the rate environment, because that should and will have an impact on how the loan is structured and paid going forward.
So we talked a little bit about what real estate is. We talked a little bit about, we talked a little bit about terms and how those work. Let's talk about how we get the deal actually approved.
Okay.
So let's, from a very high level, let's hit on the 2 or 3 main points that banks are looking at as like the primary things. Let's start off with leverage.
Leverage. Yeah.
Okay. Explain to everybody what leverage is and how banks are looking at when it comes to lending on real estate.
So leverage, or how levered your business is with debt, not too dissimilar when you're looking at somebody individually, right? With sort of debt to income levels. Personally, leverage is how much debt a business can take on and sustain and still meet their minimum obligations and payments and so on and so forth. As a general rule of thumb, most banks will look at a leverage level in about the 3 to 3.5 times range. And what that means when you talk about your true income level, EBITDA. We'll get into EBITDA in a later podcast. But when you look at your EBITDA, how much money the business is making, a multiple of that number is considered leverage. So for round numbers, let's say you make $1 million of EBITDA, you should have between 3 and 3.5 million of debt.
Well, you shouldn't have it, but you should have no more.
No
than
more
that.
than that.
Yeah.
Exactly. I didn't mean you have to have that much, but that's generally the upper end guardrail as to how much debt a business can take on. Now, the reason that has come into play over years, it's just based on statistical data over many, many, many decades, because we find as a bank and an institution, once your leverage exceeds 3.5 times, what we start to see is higher failure rates.
Yeah.
And that's no different than if you were to go for a personal home mortgage and you take the absolute pinnacle, highest you are qualified for. Well, that assumes that your level of income is going to be maintained. What if there's a drop in your income level and you can't meet those payments? The same goes for a business. And most banks should be advisory in this capacity, where we have to sometimes scale the debt ask back for a company for their own benefit, because we don't want to put them in a place where they're open to failure and not being able to meet the debt payments.
So just so we're absolutely clear on this is all the debt that you have out there divided by your EBITDA. So if you have a large line of credit out there, you have some equipment financing, those things are going to all go into your
this is cumulative
leverage profile. And so when we look at your leverage profile, if you have all this other additional debt, that's going to limit your capacity to borrow for real estate.
Yeah, that's a good point. Leverage is not just on the current credit ask.
Yes.
It's everything that you're asking for and everything that you have.
Yes.
That's the debt picture. That's leverage.
So that's kind of one of the first things. That's kind of that's more of a balance sheet thing.
That's a balance sheet item, absolutely.
Let's go to the other side of the table and let's talk about debt service coverage.
Right. So now we're talking about the income side of the house. And a general rule of thumb, and this is across all banking with a few exceptions, but we're basically looking at a 1.25 times debt service coverage. And what that means is for every dollar of debt you've taken on, to the earlier point, all your debt, all your obligations, your automobile payments, equipment loan, your line of credit in your building, whatever you have, for all of that debt, you need to generate at least a minimum of $1.25 of profit to be able to service that debt.
Yeah. So exactly. So what Adam's saying is, if you have $1 million in debt and your payments for that particular year of debt and of principal and interest is $100,000, you should have made $125,000 minimum. Mm-hmm. So if you're looking at your deal right now and you're trying to say, am I going to qualify for some debt? These are actually probably the two biggest things that the banks are looking at. So if you can say, what's my total debt going to be and how does that look from a leverage standpoint? Am I going to be under 3.5 times? And then from a debt service capacity, what will the payments be with this new debt and all my other debt? And how does my earnings, am I making 1.25 times my payments? For the most part, that's gonna get you in a ballpark where you're ready for a conversation. You're ready to maybe.
I get pushback on this more than probably anything else. That when I go through numbers with a client, why can't I just earn 1-to-1? If I have a P&I aggregate payments of $100,000, why can't I just make $100,000? Why does it have to be in excess of that?
Yeah. Well, like you said earlier, business cycles happen. Companies go up and down. There's things that are happening to your business. There might be a shock that you're not prepared for. The bank wants to feel comfortable that if you've got a little bit of a shock, your
cushion.
Income could withstand that. And so those are kind of the main two things. There are other covenants from time to time that banks will put on, like for specific industries or specific companies, depending on what's going on there. But what I do see a lot happen is I'll have somebody come to me and they don't even think about the cash flow. They're like, I'm going to buy this property. Mm-hmm. I'm putting this much money down. Like, your loan to value is only 50%. Like, why can't you lend it to me? Right. Well, because the bank doesn't want to take that property.
Yeah.
The bank is looking, can you service the debt?
Well, I've said this before. Most banks are not collateral lenders. We don't want to take this commercial property. It's a guardrail. If we need to take it, certainly we will. But we want the business to succeed, and we want to put a business in a spot where they will succeed. It's cool that we have a 50% loan to value. That's great. But our bank is not in the business of selling real estate. That's not what we want to do. Yeah. It's not where we want to be.
Okay. Let's talk about two other things real quickly that are kind of related. flood and environmental.
Yeah, this is important because, again, you oftentimes from clients get the parallel to their personal real estate, their residential property, and why is that any different than commercial grade property? Well, absolutely, it's exponentially different. When you're in a house in a subdivision and it's been plotted and planned, there's very little by way of flood and more specifically environmental issues that are going to impact you. But when you have commercial properties, especially like what we talked about earlier, specialty use, we run into this a lot as just a for example with gas stations that have huge tanks underground.
Yep.
Well, that can creep up and have very significant environmental impacts on the business and the surrounding area. That's very critical to the bank's risk appetite for that type of property.
Because let's say you buy that property and you find out there's a leakage from those tanks that were in there. Well, what's the first thing that's going to happen is like the government and everybody else is going to come to the owner of that building
You're liable
for remediation.
100%.
And that can get very expensive. And so what are banks doing in order to protect themselves for this? The first thing they're going to do is they're going to do what's called like a desktop environmental search. And what that's basically doing is it's looking at the history of the property. What kind of businesses were there before? Was there anything there before that would prompt us to have a concern? What was there? Like for example, I think like paint booths are not. Like paint booths for your car. That's not. That's something that could prompt an issue. Something where there used to be a dry cleaners. They use a lot of chemicals in that. Was there a chemical manufacturing plant there before? How were they disposing of their chemicals? Like. You said the tanks for there. And so what happens is that first level of screening is going to come by. And if everything comes through fine, that's fine. It's not going to really cost you any money. It might be $100 or $200, some nominal fee. But if there's an issue there, what they're going to do is they're going to require what's called a phase 1 environmental study. Okay. Phase 1 environmental studies is a study by an environmental firm that's going to come test the soil and look at the property and see if there's anything in there that needs to be explored further or that is causing a major concern. It's going to be a thick little study on it, and it's going to cost the client money. And this could be $10,000 depending on the size of the site, depending on what it is. And that's just the phase 1.
I was going to say that's assuming you can stay in phase 1, because phase 2 comes next, and that's even more in depth.
Yeah, that's more in depth. They're taking drilling down holes into the earth, pulling out samples, testing it, doing all kinds of analysis on it, getting an idea. And so a lot of times when it gets to the environmental point, if it gets to a phase 1, a lot of times that kills a deal. I've seen it. And if it gets to a phase 2, I mean, rarely do companies buy that property.
Yeah, as for example, I had a deal that got killed in the phase 2 search. Phase 1 environmental went through. No issues, at least kind of on the surface level. But they were this business was moving into a property that years prior had been occupied by a chemical company, and there was chemical seepage from underground that really at first inspection was not found to be an issue. Phase 2 found that there was significant chemical leakage. I believe it penetrated the bladder that was around the property, or so on and so forth. And not only was there major remediation and cost, like 6 figures that should have gone into fixing the issue. There was also now litigation issues with surrounding companies that had seepage on their property as a result. Absolutely killed the deal.
And you got to understand too, I mean, if seepage of some chemical gets into groundwater supply, that travels far. I mean, I've heard of situations where chemicals got into groundwater supply and it's like miles away having issues, and they track it back. So, I mean, you want to avoid those. You might be upset because it's killing your deal, but you probably are going to be in the long run happy that you didn't have to deal with those issues. Just since we didn't talk about flood too much, one thing I just wanted to mention real briefly on flood. The bank's going to do a flood search to see if you're in a floodplain. If you're in the 100-year floodplain, they're going to be asking you to get flood insurance on it. I mean, really, on residential real estate, you got to do the same thing.
Correct.
And then if a bank has a loan and you get mapped in, you're going to have to get the flood insurance, and if you don't get it, the bank's going to buy it for you.
Yeah, and it's called a forced place.
Yeah, and they're going to charge you for it, but they're going to buy it for you because they're not going to go without getting that. The only thing you can really do to fight against that, since it's kind of done by the government, is you can get what's called an elevation study, or what's it called?
Elevation study.
Elevation study, and basically they'll come out and they'll like measure the elevation of your property, and if you and then it'll be more exact whether or not.
In case it changed since when the area was initially mapped. A lot of things change over time, so that is a possible appeal.
So that's kind of the other thing. Let's talk real quickly on rates. We mentioned that they can be floating or fixed rates.
Right.
The bank has a couple of ways that they fix rates. So the first way is they'll just give you what they call a friddle rate, which is their kind of bank constituted rate. They make it up based on, typically it's based off of like swap rates and like long-term treasuries that match the tenor of your loan. I won't get into all that, but they have their own rate. Another way that you'll see is with the swap. You might hear that term. That's called an interest rate swap. And basically what they're doing there is they're buying a derivative and then they're using that to fix the term. And it's a little bit more of a complicated process, but really it is what I just said. It's just you're swapping a fixed rate for a floating rate, and they have licensed individuals that'll come out and explain it all to you.
And that's a hedging tool, right? If you believe there's going to be a certain volatility in movement in rates, and you don't want to be subject to that volatility in the rates, that is an offering where you shield yourself from a severe movement in rates.
One thing I would say about the swap, if you're going to use a swap to fix your rate, it does complicate prepayment of a loan. And so that's important if you sell the property or if you get a windfall and want to pay the loan off. If rates have not gone up, generally you're going to have a breakage fee to break the swap.
Right.
Because you're entering into a contract saying that you're going to, for this amount of money, you're going to swap the interest rate for so long a period
of time.
Yeah.
And so if you deviate that and you want to pay down more, that's going to be an issue. If rates haven't gone up, if rates have gone up, you might be able to get out.
So you're talking about, and we're going to talk about very high level. You're talking about when your swap is in the money versus out of the money, right?
Yeah.
And that's that breakage fee when you're out of the money, i.e., the bank has lent money and rates have maybe gone down. To break that, the bank then has to relend that money at a lower rate. That's at a cost to the bank because we should have been making at the rate that was agreed upon, and rates have gone down. Now we're reinvesting at a lower rate.
I mean, you're almost talking about prepayment penalty. The swap is like really not a contract with the bank. The swap is it's a derivative. It's in the public markets. It's in between two counterparties. But you're right on. If you are doing a prepayment penalty, a lot of times prepayment. A lot of times banks in their owner-occupied real estate, they will have language in there. Like, this is unlike residential mortgage,
where you can pay off your mortgage tomorrow if you wanted to.
Most banks will have some sort of prepayment penalty, and it could be a make-whole provision, which is kind of what Adam was talking about, which is basically saying the bank was intending to make this much money on your deal. If rates don't rise, then we can't redeploy that money and earn a better rate of return on that same money. So you have to make us whole based on kind of the change in the rates. Or they might have like a specific penalty where they say, okay, the first year, if you pay off, you got to pay 3% penalty, second year, 2%, third year, 1%. All right.
You see that a lot with SBA. It's like a 5, 4, 3, 2, 1.
Yeah. And so there's different prepayment penalties. So ask your banker about your specific deal, talk to them through that. And most of the time, they can eliminate the prepayment penalty. It's going to cost you money though.
Well, the prepayment penalty also plays a big factor on what your rate is. If your rate is fixed the entire time versus floating, typically with floating, there could potentially be a window to prepay because in theory, your rate is floating the entire time to account for market volatility, whereas fixed, you're locked into a certain rate. So if you're to the plus or to the minus, the bank may have a prepayment penalty in there based on if they want to deploy that capital at a higher or lower rate.
Yeah, that's a negotiating point, but it's something that's going to be in your loan. And so make sure you're asking about it, and then realize that if you are requiring if you tell them I don't want to have any prepayment penalty, your rate is probably going to be a little bit more expensive.
Right.
I mean, it might not be dramatically more expensive, but it could be a quarter point. It could be 40 basis points. It kind of depends on the deal, and then it depends on the rate environment as well. But I think those are kind of the major points. Is there anything you think that we're thinking? I mean, look, this is a very high level.
We could talk about this for 2 more hours.
Yeah.
So there's a lot left off the table.
But we're trying to give you guys a framework of how the deals work, so you can kind of understand. And these are kind of the major points. Is there anything that you think we might have left off? Or like I said, we can go in depth on anything. But
this was a very high level view. As we always, say and ask, if there's anything, a little bit more granular and more detailed, please reach out to Basim or myself. We'd be more than happy to kind of walk you through any more details that you might have. But the reason we wanted to do this topic is that we see this as one of the main lending sources that we see for most businesses. It's critically important. It's also going to be one of your larger notes for the business. So we want to make sure that you've set yourself up for success and the why behind what a bank is looking at.
Yeah. And, talk to your banker, because they love doing these type of deals, because in opposition to a line of credit, they know it's going to be funded at the time of closing. Generally, these perform better than some other types of deals. And, those details, if you have a good banker, they're going to want to walk through and explain everything to you. So talk to your financial professionals. But, if you have any of these, we're going to go in granular on some of these things on separate podcasts. Yeah. Like, for example, when we talk about EBITDA, we're going to go do a whole podcast just on EBITDA and what that means. And then, but we really think that this is an important topic, and it's something that a lot of business owners think about. And I've seen a lot of business owners actually use the owner-occupied real estate as almost as like a retirement policy. Absolutely. So they'll sell their business and retain their real estate and have signed a lease with the operating company, and then they've got 10 years
as a continual income stream after the fact.
Yeah,
it is every bit of an investment in that respect.
So it can definitely be something that's very lucrative to the business owner, and you don't see larger businesses generally buying their own properties as much, but generally in that, $10 to $100 million range, a lot of people buying them,
Right.
So anyways, but why don't you sign us off, and thank you guys for everything.
Yeah, no, absolutely. Thanks for joining. It's been Capital Interactive yet again. We got Basim, myself. As always, we're here to answer any follow-up questions and issues you have. Stay tuned for more podcasts, and I think that does it for today.
Thanks a lot. Thanks, guys. Bye.